If you just looked at it straight away today, you might think, oh, I'm not sure it looks the cheapest stock in the world. There's potential for it maybe getting cheaper, and maybe that will happen. But I think personally from here, and as I say, I added last week, I think you've just got to look forward a few years, look at what rating it could be after they make some acquisitions.
Hello and welcome to the Fund Your Retirement Podcast, a guest-led podcast aimed at sharing insights and strategies that help you build long-term wealth. Today I'm delighted to introduce John Rosier. John Rosier is a former City fund manager turned esteemed financial writer who runs the model portfolio, the JIC Portfolio, which John started in 2012 and has returned 303% versus the FTSE All-Share of 125% over the same period. John discusses in detail his investment approach, the value of keeping a detailed investment diary, what he's been adding to his portfolio over recent months, and we hear about the importance of dividends, which have grown from $2,000 a year to a projected $29,000 a year. And finally, John shares what he would say to those who are just getting started. Hello, John. Thank you for joining us today.
It's a pleasure, really.
So how did you get started in your investing journey? Where did it all begin?
Gosh, my elder brother, he's 10 years older than me, but he worked back in the early 80s at Mercury Asset Management. I think it was Warburg Investment Management in those days. And he got me a holiday job there a couple of times, 3 or 4 weeks from university. I remember one Easter I was there, and people in the city of a certain age will remember Carol Galley, who was the sort of head of investment at Warburg's Investment Management. She was quite a scary character, actually, but very nice person, I must say. But in a work context, she was very demanding.
Yeah.
I had to write the morning meeting notes, which actually was a really good way of learning. So that sort of got me interested. And then I applied from university and I got a job at Fleming Investment Management, which was for me ideal because it involved investment. And I started there in the sort of research department. So I got sort of 5-6 years, a good base in terms of analysis of companies. I really wanted to manage portfolios. So after, I think, being there 6 years, I moved across and started managing portfolios. But it was interesting because the sort of portfolios we were managing, they were final salary pension schemes for corporate schemes or local authority schemes, that sort of thing. But, in those days, we had 65% in UK equities of the portfolios. I understand now it's about 5%. So it was 65% UK equities, maybe 30% overseas equities, and then there was maybe 5% in bonds, and just gone the other way. But also the other thing about the portfolios were we were trying to achieve 1 to 1.5% outperformance of the all-share every year. And you were doing this over rolling 3 years generally. I mean, if you compound that up on a big corporate scheme, that's a lot of money. But it did mean that you spent quite a lot of time in meetings working out whether you should be 1% overweight shell or 1% underweight. Very different from obviously what I'm doing now, which is just trying to make money.
Yeah.
It's simple. It's very simple what I'm trying to do now.
Yeah.
It was a good grounding.
Like you say, a good grounding, a good starting point. So fast forward a few years to roughly where we are now. What type of investor would you say you are now? Then what's your investing philosophy? How do you make money from the markets then today?
If you summed it up, I'd say it's GARP, it's growth at the right price, or maybe call it GARV, growth at the right valuation. And there's a sort of a big V on the valuation, because I think that's the most important thing. The valuation, it determines how well you do out of any asset that you buy, the valuation you buy it at generally. And so if you can buy it where the valuation is on your side, in other words, the risk is on your side, then that helps. So the sort of thing I'm looking for is a stock which is reasonably priced. I love things that are on a P of 12, 13, 14, 15, that sort of level, where I can see the scope for it being re-rated. In other words, attracting other buyers in who go, gosh, this looks like a good story. And they drive the rating up to 20 times, until 22, whatever. If you can then combine that with a stock that's doing well and beating expectations, so that, at each trading update or at each result statement or whatever, people are going, wow, those are good results, and the analysts are having to upgrade their forecast, then even better, because then you're getting a re-rating and also you're getting a re-rating on higher numbers. So the double whammy that we're all looking for. And then the other thing is, so that's my general approach. But I have to say, over the last 18 months, 2 years, I really focused much more on sort of value. So I've got quite a lot of stocks in the portfolio now that basically have cash on the balance sheet, pretty lowly rated, and are paying good dividends. We're in a difficult situation at the moment, maybe getting better. I'm getting a bit more optimistic second half of the year and going forward for mid-cap and small-cap stocks, which are having a difficult time. Anyway, so, if I can get decent yield, and I can feel fairly confident that dividend's going to be paid because the balance sheet's strong and actually the stock's performing reasonably well, then I feel that can tide me over as we go through this patch. And then hopefully those stocks will also be revalued upwards.
If we move on to your portfolio, then the JIC portfolio, since its inception of 2012, it's returned 303%. For anyone who's wondering what the FTSE All Share's done, 125%.
Yeah, that's right. Yeah, it's a little bit down on that this month.
The dividend returns on it were quite impressive as well, weren't they, to go alongside?
Yeah. Yeah. Okay. We'll touch on the income and how that's an important part. I started managing my own money in sort of 2009-10, sort of full time. And I really enjoyed it. I thought that was good, but I didn't find it quite fulfilling enough in terms of using up my time and things. And I got the idea for John's Investment Chronicle from other sites I'd seen, but no one was actually doing what I was doing. So what I decided was in January 12, I would start off the JIC portfolio. And I just started off with a sum of money. I chose £151,000. And I would then basically share my diary in terms of what I was doing with that money. Any investments I made, I would explain within sort of 15 minutes why I bought the stock. I would update when there was any news on the stock. And I would also show the portfolio at all times, complete transparency. By always showing any transaction within sort of 15 minutes of doing it, and showing the contract note, by the way. My members or readers of the diary, they're my auditors. Can't buy a stock and the next day there's a profit warning and then pretend I didn't buy it. That was the idea behind it. It's been going 11 and a half years now and compounded at roughly 13% a year since then. But the compound is the important part of all this, because the great thing about the portfolio is nothing goes in or out. The dividends stay in, and I've never added money to it. And it includes dealing costs and all that. They're all built in. I run it on ShareScope, actually, which has just been fantastic, having all the sort of details going back. I said it started with 151,000, and the income in 2012 was £2,919. I won't go through every year. We'll just pick some out. By 2016, 17, it was up to 11,097. And then in 21, it was 14,336. Then last year, as I said, I've had much more of an emphasis on value stocks. The dividend income was 31,104. So on a portfolio that's roughly 600,000 now, that's 5.5, just over 5.5. So far this year, actual income received is 9,778, and declared or announced, but yet to be paid, is 19,058. My sort of forecast going through each of the stocks is that it will be something nearer to 35,000 this year.
Yeah.
And that just stays in the portfolio, gets reinvested, and helps in the sort of compounding of the portfolio.
That's fantastic. It really is.
I'll tell you what, I love this. A couple of years ago, I turned 60. And I read this thing about Warren Buffett, that he made 90% of his money between the age of 60 and the age of 90. You hear that number, you think, bloody hell, incredible record. And you just think, God, that he must be doing 15, 20% a year. I don't know. Anyway, so I did the math. To be able to do that, over those 30 years, to turn £100 into 1,000, you need to do 7.7% per annum. I think it's achievable.
Yeah.
Although I must say, given the last 2 years, which haven't been great to me, I've now got to, over the next 28 years, make 8.7% to be able to do that by the time I'm 90. But it does show the impact of compounding.
So you're looking forward to the next 30-ish years as your pick, the time that you'll make and let the sun shine, so to speak.
Exactly. And also they'll have the added benefit of, hopefully, after mortgages and all that horrible stuff, of putting money in each month. as well. And that's the important thing.
Yeah, pound cost averaging, isn't it? When the market dips, as long as you still keep buying, and that you get the upside potential. Would you give us a flavour of a couple of good performers, or maybe a couple that you've mentioned just recently that you've added?
Okay, so of my 10 biggest contributors in terms of actual monetary amount of profit, the top 5 are still in the portfolio. And of the 10, 6 are in the portfolio. 1 was taken over and 3 I sold for profit. So if we go through the largest profit I've got at the moment in monetary terms is SDI Group, Scientific Digital Instruments. I first bought that in January 19. We were talking first purchase with sort of 38p. I added a bit over the following year. Occasionally I've reduced a bit. More recently, actually, over the last 4 or 5 trades have been purchases between 148 last week and 160. The stock having peaked at about 250 last year. To me, I like the management. That's important. I also like what they're doing, which is it's a buy and build strategy. They're focused on scientific instruments. So a lot of their customers are maybe universities or research houses, etc. But what I like about them is that they're disciplined about what they acquire in terms of what they pay, and they let companies carry on running themselves, but within this sort of federation, then try and do the sort of cross-selling and the benefits of being part of the bigger group. But it does mean that by paying the right price, and as long as the companies, and they bought well in terms of the companies, they continue to show some growth and organic growth, you do get quite good earnings enhancement each time they make an acquisition. They've not made one for a few months now, but I would hope that they'll make another in the next 6 months, second half of this year. And again, you would then hope to see earnings enhancement. If you just looked at it straight away today, you might think, oh, I'm not sure it looks the cheapest stock in the world. There's potential for it maybe getting cheaper, and maybe that will happen. But I think personally from here, and as I say, I added last week when it fell after their trading update, I think you've just got to look forward a few years, look at what rating it could be after they make some acquisitions. A bigger competitor of it is maybe Judges Scientific, and they've been an amazing performer, but it's not a straight line from bottom left to top right. There's been a few times where the share price come back quite some way, but sticking with it's been the right thing to do. And I think SDI falls into that cap. Then my next biggest is Bioventic. And I mean, I love this guy. My first share was bought in October 14 at £6.89. They're currently £36.50. They've been as high sort of last year. When was it? No, November 20, they were as high as 45 quid. They're a bit off the top, but well off the lows of last year. What do I like about Bioventic? Very high gross margins, very high net margins, very high return on capital. Incredibly high return on capital. You're talking from memory 70%, and a pretty good moat in terms of people being able to break in and replicate what they do. And that comes from their skills and where they work in creating monoclonal antibodies for use in testing. Just for people who don't know anything about it, if they go to the GP or they go to the hospital and the doctor says you need a vitamin D test, I think you're low on vitamin D, they would give some blood. It'll then go into a machine, most likely made by Siemens or Philips or something like that. The test result will come back. Bioventic effectively developed the antibody that will show whether they're short or of vitamin D or not. And so once someone like Siemens using their antibody, then that's for the life of the product. And every time someone has a test, Bioventic's got a few pennies. And the big story for them, there's a few big stories, but the one that's growing at the moment is one high sensitivity troponin test. If you suspect you're having a heart attack and go to hospital, first thing they'll do is take blood. If you're having a heart attack, you release troponin, it's a protein, into the bloodstream, and it helps diagnosis. You know, you talk about a moat. I was reading something, I think on Bloomberg, and it came up about AI being used in the UK now in hospitals for heart attacks. I thought, oh my God, that's the end of troponin. I read the article, and actually it was to make sure that you got a better result in reading those troponin results. So you still have the troponin test. So the great thing about this company, I think it just generates so much cash.
Mm.
And they say they like to have 5 million of cash on the balance sheet. Anything above that, they return in terms of dividends, and then normally a special dividend every year. And it's got a decent yield on it at the moment. So the other 5 that I hold that are in my top 5 of profit makers are Serica Energy, which again I've held for a long time, North Sea gas, and now oil producer. It's sort of 50-50 gas and oil. Very good yield on it. Suffered this year because of the energy profits levy, but it's one I'm sticking with because of very nice dividend yield, lots of cash flow. I think it's very cheap. I think people are selling it now or giving it away. Rock Mining Trust 4th and Sylvania Platinum 5th. Then at the other end are my losers.
Yeah, that's the bit that most people don't want to talk about, but I was going to give you a bit of a prod on the other end of the portfolio.
Yeah, I mean, I'm very happy to talk about these.
Yeah, excellent.
Because I have to say, one of the area I really struggle with. I've been doing this for 40 years.
Yeah,
I really struggle with stop losses and whether to use them, how to use them, at what level to use them. And I've been giving it a lot of thought actually ahead of our chat today. And I've got some thoughts which I won't go into at the moment, but I've got to get better at that. Because if we take it another way and look at my 10 biggest losers over the last 11, nearly 12 years, is nowhere as large as my biggest winners.
Yeah.
So
that's a good thing.
That helps.
That's the ideal.
Yeah. But they're still too big. And so what I spent a bit of time at this morning was looking, when I crystallized the loss, what percentage of the portfolio at that time did it represent in terms of the loss? I'm quite embarrassed to say that 3 of them have actually been in the last 18 months. My 3 largest losers have been in the last 18 months. Maybe that's because of the bear market or whatever. But IOG, which I sold in January this year, that cost me 2.6% of the value of the portfolio. VLG, which I sold beginning of last year, 2.5%, and also Supreme, 2.6%. So 3 stocks, their costs sort of 7.5% of the value of the portfolio. And I look at them and you just think that is too big a loss. And so I was sitting there and thinking, maybe you should set an arbitrary, maybe you say 1%. So that would obviously depend on the size of the stock in your portfolio as to what would represent 1% of the portfolio in terms of a loss. But I'm not sure that's the right way, because there's lots of stocks I'd have cut out when actually I was doing the opposite and adding to them, and they then go off and perform well. So anyway, it's something I'm grappling with and trying to come up with some way of at least making sure that in my diary, I confront it at a level and explain what I'm going to do about it. And that actually then might make me cut. If you're not prepared to add, then maybe that's what you should be doing. It's really difficult though.
It's an interesting, isn't it? Because if you go the mechanical way and just have an arbitrary stop loss, as you said, what other stocks, if you'd have had an arbitrary stop loss at 1% or 1.5%, what other stocks in the past in the portfolio would have been cut when they fell, but it was more of a stock market overall move than the potential change in the company's fortunes? How many of those companies would have removed from the portfolio that have actually gone on to nice returns? It's an interesting one. May I press you on some thoughts that you've had of ideas since you've been thinking about it, just for the audiences?
Okay, well, again, I mean, using ShareScope on the charts is I literally have a trailing stop loss that runs on the thing at 20% from the high. Because at the moment, I've just been going through my biggest losses in absolute terms. But I mean, a salutary lesson is something like, do you remember Crawshaw, the butchers up in Leeds? I bought that in November 2013 at 13 pence. Peaked exactly 2 years later at 95 pence. I eventually sold all of my position, traded them, and I'd added and trimmed a bit of things over the time, but I eventually sold all of my position in June 2017 at 28.5 pence. So I made a good profit, but compared to the peak, I'd let it fall from the peak to there. Had I reviewed it properly on the way down, or was I? So what I decided I've really got to do and be disciplined about is I've set a 20% line on the chart that will move. Price goes up, the trailing stop. If it closes below that level, I will then write a note on the stock explaining what I'm going to do. I think hopefully that will help me clarify my thoughts. If it's just because the stock market's having moved down and things like that, then fine, but you've got to be pretty sure that's why it's done it. But if there are earnings downgrades or trying to understand what people are concerned about, etc., and if I'm at the stage where, having given a 20% fall from the top, if I can't answer the question, if I didn't hold it now, would I buy it now? Then I've got to make some sort of decision about reducing, cutting, halving, maybe getting rid of the whole thing and just moving on and see if that will help me in what I say I find the most difficult part of investing.
Yeah, it's really interesting this, and I hope the audience is appreciating what you're saying here, because there's so much focus on what to buy, what company is the next multi-bagger. Actually, I hear it time and time again with the private investors we've had on. The selling side of it is also so difficult. I really
Yeah.
appreciate you sharing that insight there, and really good of you.
Yeah.
Thank you.
I mean, I've looked at all of my positions, again, since I started 11 years ago. 60% of investments I have made are up, made money, or are in the portfolio making money. And the other 40% were losses. Now, that's fine. 60-40 is fine. You've just got to make sure that the 40% are not from the things that knock 2.5% off your performance. As they knock 0.5% off, then fine. That would improve my performance if I could be better at doing that.
Yeah. Yeah. So the 20% arbitrary line would be like an alert type thing, would it? That would then, you've got the alert, 20% off the share price. That would mean for you to dig deep into that company and find out what's happening.
Absolutely. Dig deep, understand why it's going down. And one of the books I've just finished reading is Mistakes Every Investor Makes. I don't know if you read, by Joachim Clement.
I've not read it, but I will add it to my list.
It's quite a good book, actually. There's parts of it, but I think it's good. Anyway, there's 7 big mistakes people make. He goes into, I quite like this, and long term is not the sum of the short terms. Anyway, but he goes into stop losses and that. And it's, are you a long term investor or just stubborn? I'm worried that perhaps at times I may be a little, it rang a bell with me. Perhaps I'm a little stubborn. So I think by at least forcing me to put my thoughts down, hopefully I can overcome being stubborn. Because writing a diary, I find really helpful. I think anyone should write a diary because you can refer back to why you bought things and things. But when you publish your diary, it does make things quite difficult. Again, I read another book I read a few weeks ago by a chap called Guy Spears, The Education of a Value Investor. His sort of investment journey and how he developed his approach, etc., which is now very much a value investor approach and very successful. One of his rules is never talk about investments to other people because it makes it more difficult for you to change your mind. So that, again, is why this discipline of writing the diary and telling people you will means that if you change your mind, you can say, listen, I've always said if it drops to this level, I will review it. There's no point reviewing it if you're not prepared to change your mind.
Would you say that the diary, the public diary that you write for your subscribers, would you say it's helped you over the past decade, or has it been more of a hindrance?
I think it's definitely helped, because it's enforced a discipline on me.
Yeah.
In terms of writing a diary. There's been times when I've written up notes, because if you're going to buy a new stock and within 15 minutes of trading it, of buying it, you've got to put out your, I've just bought this stock, this is why I've done it, etc., etc. You've obviously got to write it up beforehand. And there's been quite a lot of cases where I've done all the writing up, written it up, and then I've gone, no, I'm not buying this. It's not quite right, or whatever the price. So I think that's helpful. It ensures that you're really disciplined about writing up the stock and understanding it, etc.
Yeah. Because what you're putting this out to your subscribers, right, for them to read. So it's got to be of a certain, a level of detail and presentation, hasn't it?
Yes.
And there's been occasions where you've done that and it's, oh no, actually, now I've done this.
So you sit there and think, God, I spent this morning writing that up. What a waste of time. But of course, it's not a waste of time.
No, it's absolutely not, is it?
But then the other part of the discipline is, it's 7 o'clock every morning. Sometimes something's coming, like this morning, I knew that Neox had its AGM update. So, I'm ready at 6:45 or whatever to write it up. By 8 o'clock, I've put out my initial thoughts. Then there's other days when you don't know something's coming. So I'm always there, 7 o'clock, wherever I am in the world.
Yeah. Yeah, that's
I've done
that's
this
discipline, isn't it?
I've done this at 11 o'clock midnight from Grand Canyon once.
Yeah.
Anyway,
Yeah, but that's the discipline, isn't it? That's the habitual habit of maintaining the routine. We're habitual creatures and routine helps. And it's quite another good
yeah,
insight for anybody who's looking to start anything really. Get yourself
yeah,
into a routine and it makes things much easier.
yeah. And if you're working, if you're full-time working,
Yeah.
you've got a young family, you've got whatever, where do you find the time? Maybe picking individual stocks then, unless you really can find the time, it's not something perhaps you should do at that stage.
Yeah.
Because you do need to have time to do it. For me, it's fantastic to say I'm retired, but have found something that will keep you going forever, I hope.
Yeah. It's something that you're clearly passionate about and that you love doing. So what would you say to the person who's listening, perhaps new, that they're just getting started, they're kind of exploring this idea of the stock market, understanding how to value stocks, things like that. With all your 40 years of experience, what would you say to them?
It's reading. You've got to read. I think there's some good books you can read.
Yeah.
Things like Simple But Not Easy by Richard Oldfield and things like I think are very useful. The Naked Traders books are good, I think, in terms of the basics of understanding how to value a company and what to look for and things. Go to the Mellow Conference if you can, where you meet companies and you meet other investors. Things like Investor Meet Company. You can watch presentations and things, but you've really got to, I think, put the time in to learn. And then the next thing is the sort of discipline. And I think the discipline of saying, I'm going to put this much money into the stock market every month. So start early. The earlier, the better. The best thing is to start when you're zero. If you've got a wealthy grandparent who decides when you're born, you can put 2880 into a SIP or something, which grosses up to 3600.
Yeah.
And I think you've only got to make about 5% a year or something. You get to 350,000 by the time you're 60. So start early. Not everyone can start at that age, but if you can start when you're 25 or 28 or 30, and then just put money in every month, that's the important thing. And obviously, when you start, I wouldn't pick individual stocks. I'd find an investment trust, sort of maybe a global one, and put money in each month until you built up to a certain level where it can make sense to start picking individual stocks.
Yeah.
Because the cost, main thing I'm talking about cost. If you're putting £500 into a stock, by the time you pay dealing charges and stamp duty and things like that, and the spread, it becomes quite costly. So I think you need to get to a certain level. And also it gets used to putting the money in every month and over time seeing it grow. Don't get despondent when, you look at the end of a month and see that price has gone down and you're putting the money in, you'll be buying more stock or more units or shares in the investment trust at that price. Try not at the early stage to look too often at your portfolio. Just let it build up. And then once you've got a tidy sum, then maybe you can then think about buying individual stocks.
I guess over that period as well, that's the educational period as well, isn't it? During that time, which could over be a few years.
Yeah.
Couple of decades even maybe, is
Yeah.
you're reading, you're learning, you're listening to podcasts, your membership area, and learn through your diary, things like that, so that you're not actually going straight in at, oh, I must find the next multi-bagger.
No.
You can gradually ease yourself in. And of course, before you do any of that, you need to speak to a financial advisor, a regulated financial advisor, first of all, to make sure that you've got all the right advice in front of you before you make any financial decisions. So
yeah, absolutely. Very important.
Yeah, that's definitely the first step. John, that was absolutely brilliant, really excellent. Where can the audience follow? Where can they connect with you? Where can they learn more from you?
Okay, I write monthly in the Investors Chronicle. So that's one way. Or the other is at my website, which is jicuk.com. And I do a 2-week free trial. You get plenty of warnings, like 3 days beforehand. If you want to cancel, press this button. It's all very easy. But luckily, not many do.
Yes, I will make sure that all those links are in the show notes below. So if you want to learn more from John, scroll down. All the links will be there to take to his website. And I'll also put in his Twitter handle there as well for you to follow him. But yeah, thank you, John. That was really interesting, really good insights there. Thank you very much for sharing them.
Great, thank you. I enjoyed our chat. I hope to do it again.
Well, that's it for another episode. If you enjoyed this episode, please subscribe and leave us a comment to let us know. And don't forget to check out our other investing-related podcasts on the Fund Retirement Podcast Network. I hope you have a great day, and thanks for listening.